So today we are going to be talking much more on currency pairs, understanding currency pairs and everything you need to know when it has to do with currency pairs. Previously we talked about major currency and then minor currency and exotic currency. Now we want to talk about major currency pairs, minor currency pairs, and exotic currency pairs, which means that each pair of two currencies, they have the category where they belong, either being major, either being minor, or being exotic, and you have to pay attention to which pairs you are trading. It determines your result. It is very important that you understand the pair you are trading so that you can make decisions based on proper understanding. Let's start by saying currency pairs. What are currency pairs? Like we said earlier in the earlier video, that currency pair is a pair of two currencies to make one. That is currency pair. So not to waste the time, what is it to understand about currency pairs? Now, before we go further into this, I would like to let you know that is it only currency pairs that we trade in Forex? Is it only Euro USD, GBP, JPY that we trade in Forex? No, there's so many other things we trade in Forex, like commodities, like gold, like silver. Those are commodities. And we also trade stocks, like US 30, US 100, many more. So, but in this video, in this course, we're only going to be focusing on Forex, which is currency pairs. Currency pairs are categorized into three. Number one, we have the major currency pairs, we have the minor currency pairs, and then we have the exotic currency pairs. Now, remember from the previous video that we talk about the major currencies, the minor currencies, and the exotic currencies. Now we are talking about the major currency pairs, the minor currency pairs, and the exotic currency pairs. What's the difference? Any currency that belongs to the major currency group and is paired with the US dollar is a major currency pair. What does that mean? Any pair of currency that belong to the major currency group and is paired with the USD is identified as a major currency pair. What this is telling us is just that for every currency that is being paired with USD and that same currency belongs to the major currency group, that currency pair now is a major currency pair. Why are there major currency pairs? Why are they called major currency pair? Well, they are called major currency pairs, number one, because they belong to the group of the major currencies. Number two, because they are paired with the US dollars. And number three, because they are liquid markets. They have a very high liquidity. Now, that should take us to what liquidity means. What is liquidity? Liquidity is the availability of trading opportunities in a market. For example, now let's say there's a bakery where in that bakery there are a lot of people supplying bread to the people that are buying. Now everybody is on different queues. In as much as there's a lot of queues, there is also a lot of people to supply bread at each time, compared to a bakery whereby it's only one person that is giving bread, but then there are 1,000 people on the queue. Buying of bread will be very difficult in that kind of situation whereby it's only one person that's supplying the bread and there are 1,000 people on the queue. So until the first person buy, the second person till the 999th person, the 1000th person will not be able to buy. So that is low liquidity. But when there are 1000 people and then there are like 900 suppliers, do you understand? So there is buying and selling opportunity. The people selling, they have opportunity because there are a lot of people on the queue, and then the people buying too, they also have opportunity because there are a lot of people supplying at the moment. That is a liquid market. Now, why are major currency markets liquid? Because of the fact that a lot of people are trading United States dollar, like we said, and other currencies that are paired with it too, they are also popular currencies. So in a market whereby there's opportunity to buy and opportunity to sell at the same time, it's called a liquid market, highly liquid market. But a market that there's no liquidity, there's no buying and selling opportunity, or there's a low buying and selling opportunity, like I used the bakery as an example, someone supplying bread as an example, that market is not liquid. Now, with that being said about liquid market, let's talk about volatility. Volatility is the rate at which there is change in price in a particular market. For example, let's say there is a market that today you've gotten what's it called, a loaf of bread is 10 naira. Now 1 hour later, the loaf of bread has became 15 naira, and before you know it again, the loaf of bread has gone back to 20 naira, and before you know it again, it's back to 10 naira. That process, the market is volatile because the price is switching time to time. The price can change anytime. So the rate at which the price of a market is changing, that is what we call volatility in the forex trading. So which kind of markets are volatile? Which kind of markets are volatile? Let's define volatility. Volatility is how frequent or how often price can change in a market. Now, which pairs are volatile? Most of the times, the volatile pairs, they are the pairs that their price is unstable, which means volatility also means instability. So when you are in a market that is unstable, that means the market is volatile. Which kind of market? For example, let's use a very, very common example. Let's use the US dollar and the Nigerian naira as an example. Nigerian naira and US dollars market is a very funny market because today exchange rate can be 1,400 naira per dollar, and before you know it, before that same day goes down, exchange rate will have changed from 1,400 to 1,600 per dollar. Before the next week, exchange rate has gotten to 1,900 per dollar. Like, that fluctuation is what volatility means because the market price is not stable. So after that, let's talk about something very important that you have to learn on the forex chart: ask price and bid price. Now, the ask price is the amount that you can purchase the base currency. If you are buying, the amount at which you buy the base currency is the ask price, while the bid price is the amount at which you sell the currency pair. Now, what is spread? The spread is the difference in pips between the ask price and the bid price. What does that mean? Look at it here at the background. This distance between this, the bid price and then the ask price, that is the pip distance between both of them, is the spread, and that is how the brokers make their money. That spread, each broker has their own rule for spread. You don't have to worry so much about this. As you trade forex, you understand these things. When you see the way they behave, you understand. There's no way we can actually demonstrate everything one by one. If not, the video is going to be too long and too boring to watch. Now, we mentioned pip. When we were talking, we said a pip is the smallest price change of a given exchange rate. Let me break it down. You know motion, right? Motion is when a body is having a constant change in position. They say the body is in motion, right? A pip is like the movement of an exchange rate of a currency from one price to the other. That is, in the forex market, price move in pips. As human beings move with steps, we take steps to move, step 1, step 2, step 3. That's how human beings move. Price move in pips in the forex market. Now, for example, let's show you what pip, an example of pips. Now, look at this example. If Euro USD moves from 1.1050 to 1.1051, that 0.001 USD rise in value is 1 pip. That could be confusing. Let's use Naira. Normally we use Naira all the time. If 1 Naira 1112 kobo moves from that price to 1 Naira 1113 kobo, that is a pip movement. Let me try to put that down. I said 1 Naira 1112 kobo, it moves to 1 naira 1113 kobo. You see, this difference here is 1 pip different. Look at this Euro USD example. Euro USD is equal to 1.1051. That is, it moved from 1.1050 to 1.1051. This one, which is equal to 0.0001, is a pip. This is 1 pip. Now we also have a pipette. A pipette is like the fraction of a pip. That is, a pip divided by 10 is a pipette. Look at this. This interface is how you see it on a laptop, MT4 on a laptop, and this is how you see, the ask and bid prices on the trading view, and this is how you see it on your MetaTrader 4, on your phone. So look at these numbers that are marked out. They are pipettes. They're fractional pips. These numbers here, they are fractional pips. These numbers here, they are fractional pips. Let's open a live chart and show you. This is a chart. You can see this at the top of it. Market has actually closed now. Market closed. Even though you'd have been seeing them moving, they literally don't stay at the point. They will be moving. They will be changing. So yes, that is what a pipette is. So far in this video, I've spoken about the currency pairs. We've spoken about the major currency pairs, and we didn't really talk about the minor currency pairs because there's not too much time, but you can do your research on what the minor currency pairs are. And after that, we talk about the spread, we talk about the pips, we talk about the ask and the bid price, we talk about the liquidity, we talk about volatility. And I want you to make time and make sure that you do your research on these things that you have learned in this video today, and make sure you take notes and then keep recording everything that you learn. Thank you so much for staying this long and watching this video. I hope it's not getting boring, and I hope you're grabbing something and you're writing something down. In the next video, we're going to be talking about pip value, how to calculate pip value, how to know how much you are risking per trade across different pairs, and then we're also going to talk about broker. So so make sure you show up in the next video, because it's going to be really detailed. And after that, then we are still in the technical aspect of forex, by the way, and then that's going to take us a few more videos, and then at the end of the day, when you put the whole thing you have been learning from the first video to now and then together, you would see that something is happening to you. Thank you for staying this much long watching the video. Please do not forget to subscribe to our channel. Do not forget to like, comment your thoughts. If there is anything you think I've omitted that I'm supposed to talk about that I've forgotten, please feel free to drop it in the comment section, and then I'll be there to reach out to you. And if it's something that is worth recording a new video for, and then I'll go ahead and record a new video for it. Thank you for staying to the end of the video. Thank you. See you in the next video.